The stock market is currently closed. As of the last trading session on Friday, May 8, 2026 at 4 p.m. EDT, Opendoor Technologies, OPEN, closed at $5.01 per share, representing a decline of 5.83% for the day. While most investors are fixated on that nearly 6% drop, the reality beneath the surface tells a much more complicated story than a simple daily sell-off. The expectation in the market right now is that the high interest rate environment has effectively neutered the iBuying model, leaving companies like Opendoor to slowly bleed out. However, the reality of the latest quarterly numbers shows a company that is actually accelerating its acquisition pace at a rate we haven't seen in years. In the first quarter of 2026 alone, they secured contracts for over 5,000 homes. To put that in perspective, that is double what they managed in the fourth quarter of last year and triple their third quarter figures. This isn't just a minor uptick, it is a massive fundamental shift in their operational velocity that the current share price isn't even beginning to reflect. If you are looking at Opendoor stock through the lens of a traditional real estate agent, you are likely missing the forest for the trees. The common ground most investors stand on is the belief that Opendoor is a house flipper with better software. They see a company that buys a home, holds it on a balance sheet, and tries to sell it for a tiny margin. When rates are high and inventory is low, that looks like a recipe for disaster. But the deeper take here is that Opendoor 2.0, as management calls it, is evolving into a capital-light marketplace. They are shifting from being the sole buyer of every home to acting as a high-tech conduit between sellers and institutional buyers. This change is designed to insulate them from the very volatility that decimated their share price over the last 24 months. While the market is pricing them as a distressed asset, the internal metrics suggest a business that is finally finding its footing in a high-rate world. Looking at the recent daily swings, the volatility we saw in the last session is a perfect example of the tension between macro fears and micro progress. The trading volume was heavy, over 53 million shares, which is significantly higher than their daily average. This suggests that large institutional players are re-evaluating their positions. We saw a similar dynamic with Nvidia stock and Apple stock earlier this year, where the underlying business model was being questioned while the actual performance was starting to turn a corner. For Opendoor, the earnings reaction from their May 7th report was a classic case of expectation versus reality. They reported a loss of 5 cents per share, which was actually a beat compared to the expected loss of 6 cents. Revenue also came in higher than some of the more bearish estimates at $720 million. Even though they missed some internal forecasts, the fact that their adjusted EBITDA break-even target for the second quarter of 2026 remains on track is the real catalyst that institutional investors are watching. When you use platforms like the SoFi trading platform or Interactive Brokers Trading to look at institutional activity, you'll see that the smart money is starting to pay attention to inventory turnover. Opendoor has managed to flatline their margin erosion. In past years, as they worked through older cohorts of homes, they would see margins drop by hundreds of basis points. Now they are seeing that drop limited to less than 1%. That is a massive improvement in pricing accuracy and risk management. If you are into online investing or self-investing, these are the boring, granular details that actually move the needle long-term. You won't find this level of nuance on the surface of most investing sites. It requires looking at how they are managing their $1.1 billion in inventory and their $999 million in unrestricted cash. They have a war chest that allows them to survive a few more quarters of turbulence while they wait for the mortgage market to normalize. Speaking of online investment help, many people use services like Schwab Intelligent Portfolios or a SoFi robo-advisor to manage their risk. But when you're dealing with a high beta play like Opendoor, you have to be your own analyst. The company's beta is sitting around 3.65, meaning it moves 3.5 times more than the broader market. That is why a 5% drop on a Friday feels so painful, but it's also why the upside can be so explosive if they hit that EBITDA break-even goal next quarter. Comment below how many shares of Opendoor you currently hold, or if you're waiting for the next Fed meeting to make a move. Hearing from you helps us see where the retail sentiment is really shifting. Now, let's step back and look at what Opendoor actually does for those who might be new to the ticker. The business model is centered on removing the friction of a traditional real estate transaction. Instead of listing a home, hosting open houses, and waiting months for a buyer who might have their financing fall through, Opendoor makes an immediate cash offer. They then take on the responsibility of repairing the home and finding a new buyer. It is a convenience at scale play. In the early days, they were often accused of overpaying for homes to grab market share. The reality was that their algorithms weren't prepared for the rapid rise in interest rates. However, the 2026 version of the company is using far more conservative underwriting. They have integrated AI-driven efficiency gains into their Opendoor 2.0 strategy that allows them to predict resale velocity with much higher accuracy. They are focusing on core cash products that have shown incredible margin stability even as the housing market remains sluggish.
If you are using the Fidelity mobile app or Robinhood app to track your individual brokerage account, you probably noticed that real estate stocks as a sector have been under immense pressure. Macroeconomic pressures like the persistence of high mortgage rates have kept many sellers on the sidelines. This is where the tension lies. The narrative is that nobody is moving, but the reality is that those who must move are looking for the certainty that Opendoor provides. This is why their acquisition contracts are up fourfold compared to late 2025. They are capturing a larger slice of a smaller pie. When the pie starts growing again, the leverage they have built into their system could lead to significant revenue growth. Analysts are already projecting a 25% increase in revenue quarter over quarter. Compare this to other tech-heavy sectors. When people look at Tesla stock, they are looking at margins and delivery numbers. With Opendoor, the deliveries are the homes sold, and the margins are the spread between the purchase price and the resale. Right now, that spread is healthy for the first time in a long time. They have cleared out the bad inventory from the high-rate shock of 2024 and 2025 and are now operating with fresh, correctly priced homes. This is a point that many investing sites miss. They look at the trailing 12-month data and see a company that lost a lot of money. They don't see the current cohort performance, which management claims is the best in the company's history, excluding the unusual pandemic period. The future outlook for Opendoor depends on two main catalysts. First is the aforementioned EBITDA breakeven. If they hit this in the second quarter, it changes the conversation from will they go bankrupt to how big can they get. That shift in narrative is where the most significant price movements usually happen. Second is the potential for a housing market thaw. Even a small reduction in mortgage rates could unleash a wave of pent-up demand. If Opendoor has the inventory and the operational capacity to handle that volume, the revenue numbers could easily exceed the current $720 million per quarter. However, the risks are real. If the economy enters a deep recession and home prices drop significantly, even the most conservative underwriting won't save them from taking losses on their $1.1 billion inventory. If you are a user of Fidelity Investments or Robinhood Investments, you know that diversification is key. Placing Opendoor in a portfolio alongside more stable assets like Fidelity ETFs or Fidelity mutual funds might be the way many professional traders handle this. It is a high-reward, high-risk play. The institutional activity we're seeing, where volume is spiking on down days, suggests that shares are being transferred from retail hands to larger funds that have a longer time horizon. These funds aren't looking at the 5% drop today. They are looking at the potential for Opendoor to become the Amazon of real estate over the next 5 to 10 years. Let's look at the expectation versus reality one more time. The expectation is that Opendoor is a failed experiment in a dead market. The reality is a leaner, more technologically advanced company that is currently seeing its best acquisition growth in years. They have nearly $1 billion in cash, improving margins, and a clear path to profitability that doesn't rely on interest rates returning to zero. When you're browsing through your Fidelity brokerage or checking your Robinhood crypto and stock holdings, it's easy to get discouraged by red days. But the authoritative take here is that Opendoor is currently undergoing a structural transformation that the market is largely ignoring. The company's focus on its capital-light marketplace is the real story for 2026. By connecting sellers with institutional buyers through their platform, they can earn fees without the risk of holding the asset. This is much more like the business models of the big tech giants we see in other sectors. If they can successfully transition a larger portion of their business to this model, the valuation of the company will likely be re-rated. Instead of being valued like a real estate company with a price-to-book ratio, they could be valued like a software-as-a-service company with a multiple on their fee revenue. That is the reality that could eventually far exceed the market's current expectations. In summary, the story of Opendoor Technologies in mid-2026 is one of a quiet recovery. While the headline price of $5.01 in the daily volatility might scare off the casual observer, the internal metrics of home acquisition, inventory turnover, and margin stability are all pointing in the right direction. We have a company that is finally learning to operate in a high-rate environment and is closing in on a major profitability milestone. The gap between the public narrative and the financial reality is wide, and that is usually where the opportunity lies for the diligent investor. Whether you are using Fidelity IRAs, Robinhood fractional shares, or an individual brokerage account, keep a close eye on the second quarter report. That will be the moment of truth for the Opendoor 2.0 strategy. The tension between what people think they know about this stock and what the data is actually showing is at an all-time high. Authority in this market comes from recognizing those shifts before the rest of the crowd does. Opendoor has spent years in the wilderness, but the path back to the top is finally starting to look clear. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.